Hello, this is Eric Parnell, Chief Market Strategist from Great Value Advisor Group. Well, the second quarter is underway, and what a quarter it's been so far. No sooner did the calendar flip to 2025 Q2 than we saw the outbreak of volatility. On April 2nd, the United States announced tariffs against countries from all around the world, and markets immediately fell into free fall. The S&P 500 falling by double digits, and although the bond market held up initially, we saw that volatility spread into bonds as well as the currency markets as well. So what should we reasonably expect going forward? The first thing to point out is that a bottom is now in. The S&P 500 reached a low of 48.35, and it has been rallying in the days since. But it's important to highlight that we've reached a critical juncture in this rally. The market was overdue for a bounce, but in that bounce it's now arrived at key technical indicators. Leading among those is the 20-day moving average, a short-term trend line that has been resistance for the market going all the way back to its February 19th highs. Now, the stock market is on the mend, but that's not going to be the key story for investors to watch in the coming weeks and the coming months. Now, we should expect more volatility. The announcement of tariffs have changed the game for global trade, and countries are going to be spending the next few months figuring out how that's all going to land. But the bigger indicators that we need to watch in the months ahead is the U.S. Treasury market and the U.S. dollar. One of the things that alarmed policymakers as we went through last week was the sharp rise in 10-year Treasury yields. It reached a low of 3.88% during the overnight heading into last Monday's trading, but since that time it spiked meaningfully higher, with the 10-year Treasury yield reaching as high as 4.6% and the 30-year Treasury yield reaching new highs just over 5%. If we see Treasury yields continuing to rise in the months ahead, that's a bad sign for the stock market outlook as well. Another area that we want to watch is the US dollar. We saw a precipitous drop in the US dollar in the immediate aftermath of these tariff announcements. And that's unusual. When we have stock market volatility, we typically see bonds and the US dollar rally because it's a safe haven destination for capital. But the fact that Treasury yields are pushing higher, meaning their prices are going down, at the same time that the US dollar was falling, suggests that capital was flowing out of this country in response to the tariffs. If we see that type of behavior continue in the coming months, that could suggest that the US leadership that we've seen in the equity market for so long could be shifting to international markets. And that's something that we want to watch from an asset allocation perspective in the months ahead. These are interesting times in capital markets in 2025, and it's reasonable to expect, as the headlines continue to flow and as the markets continue to move, that volatility will continue. This highlights the importance of broad portfolio diversification. A properly constructed asset allocation strategy is one that is designed to withstand the types of volatility that we're seeing right now. And maintaining that focus going forward will be keys to success as we continue through the remainder of 2025. Thanks for joining me for this latest Market Insight, and I look forward to seeing you again soon.